Hello and welcome to Investors Hangout, brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now today we are unpacking real estate investment trusts. In simple terms, a REIT lets you invest in a small portion of a rented building, office or mall. The big question is the money they pay you real income or is your money coming back? We'll discuss that today. Dhirendra, welcome to this discussion.
Thank you.
Let's begin with unpacking REITs. If you could elaborate on what REITs actually are.
Oh, it's self-explanatory. Real estate investment trust. This is, we put our money in a mutual fund and it buys bonds. It buys stocks, shares. And real estate investment trust, it buys commercial buildings. Commercial buildings, warehouses, malls. So it is a diversified portfolio. It's a bunch of real estate holdings in a mutual fund structure, which is called real estate investment trust.
Why not homes?
Not homes, because homes are one, we don't have a very large scale market for organized homes. It's an informal market. If I have a home, I can rent it to a person, but there isn't an organized place where I entrust my money to a trust and they in turn manage it. We don't have that pooling mechanism available. Second is that the rental yields for a residential houses is much lower. It is half as much. So lack of scalable organized marketplace for the kind of organized marketplace we have for real estate, commercial real estate, we don't have it for residential homes. And second is the yields are much lower.
Okay, so there's diversification built in REITs and even inside a single building.
Yes, because it is real estate investment trusts are built in a manner that when you invest in a REIT, it might be owner of multiple buildings, and you might have the way they are structured is there are special purpose vehicles which are pooled together to make it a real estate investment trust. And so there is a diversification, because if you own a building or a part of the building, all the tenants will not disappear one day. And if one or two, if there is a vacancy, then it will be distributed proportionately, it will be pooled proportionately. So you are not exposed to it. So the benefit of diversification in terms of income, in terms of appreciation, or in terms of holding multiple assets and having a proportionate ownership. So this itself is a great advantage. And then you are relieved of all the headache of owning real estate. You don't have to bother about the maintenance. You don't have to worry about the vacancy. You don't have to worry about the litigation. You don't have to worry about everything that is going, maintenance. All those things, that is what that vehicle is doing. There's one significant advantage of REIT, which is you invest in an asset where you get some income from that. And there's a potential of rising income, because your tenant will, his rents will be revised 3 years from now or 2 years, or depending on the rental contract. So here is one investment where there is appreciation happening, but it will be realized only when those assets are sold. That may not happen. But in the interim, while you are waiting it for, if you are a long-term income-oriented investor and your need for income is that it should rise in line with the inflation, here is an underlying which actually rises with the inflation. Because if you have commercial tenants, they will give you, say, 100 rupees a square feet today. And 3 years from now, it could well be 110 rupees. And this 10% appreciate or rise in the rental income will translate into a rising income for you. So this definitely fulfills a very desirable need for rising income from your fixed income investment with an underlying credible asset at the back.
So in which case, is it a viable option for retirees?
It can turn into a very viable and a very large market, a large opportunity for retirees to invest as and when this market evolves and presents itself as a widely available mature market.
Okay. So this rent, it reaches me directly from the tenant?
No, it comes to the special purpose vehicle, which is the REIT, and then from there it comes to you. A real estate investment trust might be a pool of multiple special purpose vehicles which own those different buildings, different towers. Those different properties will have a definite stream, and the real estate investment trust earns in 3 forms. Either it could be interest. It has lent the money to SPV. Either it could be a loan repayment or an interest on that, or a rental income. These 3 income get pooled into a real estate investment trust, and investors are the owners of the REITs. So they get that money proportionately as a result of this, and the REIT sponsor must have a reasonable exposure, must have a substantial interest in the special purpose in each vehicle. So as a result of which, they have a skin in the business. They are expected to act responsibly, and their acting responsibly translates into superior management or the ownership of that.
Okay, now can you explain what is this return of capital that everyone talks about?
Typically, a REIT sponsoring a special purpose vehicle or investing in a SPV, the special purpose vehicle, when the project gets completed and it starts getting money back, it can come back in 2-3 forms. Either there could be a repayment of interest because that money has been borrowed by the special purpose vehicle from the REIT. So it might be paying interest on that. That interest might be coming by way, the cash flow to the special purpose vehicle might have started by way of getting the either some properties being sold or the rental income which they start deriving from it, or there could be advances from the tenants. Second is that because the special purpose vehicle has taken money, it might be paying a part of it in the form, it might be paying repaying the loan. And third will be the rental income coming to you in the form of a dividend. So the component of money which is being repayment of the loan, that comes back to you. It is effectively your own money coming back. It is not an income. The money that you lent has come back.
Okay, so less like a salary, more like a amount that you lent to your friend coming back to you.
Yeah, it is your own money which has come back after the money is not needed there, so it is coming back, and that is not your income. That is not the rental income. That is not the interest on the advances received from the tenants which is getting back to you. That is your income.
Right. Now, can you explain the taxation of REITs?
Your income from REIT comes in 2-3 forms. So the component which is the rental income, that is taxed as your income. So you'll be liable for taxes. The money which is coming to you in the form of repayment of the principal, a component which you invested, when that comes, that is not treated as your income. Unlike a mutual fund where everything is deferred till the time of your redemption, when you sell, your purchase price and the sale price, the difference, and that is the taxable, and depending on the time period, it is long-term or short-term gains, and you are liable for the taxes. This will also be like that, but in the interim, all the money that you are getting, the component which is coming back to you as part of your repayment, that is not taxable, that is your money coming back. The money which is coming to you as by way in the form of dividend or the interest, that is taxed as your income in that particular period.
And if I sell my REITs, is that taxed differently?
When you sell REITs, it is treated as the tax treatment is like equity. Hold for 12 months, then it is treated as long-term capital gains 12.5%. Shorter period 20%. So any capital gains will be liable for treatment exactly like equity.
So should an investor today invest in REITs at all?
REITs have been around for a while, but we don't have too many options, and I think it is not very established. It is not a very routinized market as yet. It's not even a perfect market, close to being a perfect market, but it is evolving very rapidly. And I think investors should start considering there are vehicles where REIT is part of a larger portfolio. There are balanced advantage. Not like SIF. There are balanced advantage funds which are where the income component or the fixed income component, they can also have REIT and InvIT, and they're beginning to have that REIT in those portfolios. So that could be a good starting point. Only REIT today is not a very established, there are not too many credible options for the individual investors today. And they're evolving, and you have to be very careful at what is the underlying, understanding that and investing in that carefully. So maybe for larger investor, it might be possible. But for a small individual investor, I think they still have to wait for some time for the market to evolve to a basic level of maturity for them to participate.
So REITs are new and evolving, but keep an eye on them since they provide a promising opportunity for investors who seek rising income. That's all we have for you in this episode. Keep watching this space for more information. Thanks for watching. Bye for now.
an investor education and awareness initiative of Aditya Birla Sun Life Mutual Fund. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.